away from the release of the June employment report. So as always, I'll come back to these charts in a minute. Let's just remind ourselves of the information that's going to get announced. So as always here on this US employment report, you get actually quite a lot of numbers all announced at the same time. So it can be quite a tricky one to navigate through as a trader. This is because you can get some conflicting information. Some of this news might be good, some of it might be bad, and so you've got to very quickly make a judgment on what the overall, on average, what's the effect going to be, positive or negative, obviously depending on which asset you're looking at. But the most important, normally is the non-farm payrolls number. So I've got this highlighted, and this is for June, how many jobs were created, net figure, private and public sector. We're expecting 179,000, and that would be an improvement on the disappointing figure for May that was 138,000. I'll show you the chart for this in a minute. Payrolls has been actually very weak for the last 3 months if you're looking at the averages. So 179, okay, that's the big number. Then you get a load of kind of subcomponents to that payrolls number. So you get the private sector payrolls, you get the manufacturing sector payrolls, you get the public sector government payrolls, okay? All of these subcomponents much less important and not something you really need to be listening out for. I'd say the other big number is then the average hourly earnings. So this is measuring wage growth, and in the month of June we're expecting that wages on average went up by 0.3%. which would be a slightly faster increase than we saw in May, where the increase was plus 0.2%. We then have the unemployment rate overall, and this is expected to remain unchanged at 4.3% and remain unchanged at a decade low. Okay, we'll come and talk about unemployment a little bit later. Firstly, let's just have a look at the chart of payrolls itself. Here we go. This is looking at payrolls over the last 12 months. And 138 is the figure for May. We got 174 in April, and then this big dive to 50 if you go back to March. Do bear in mind that was impacted by the storm, so that was bad weather, had a pretty large disrupting effect to the March job creation figure, so bear that in mind. But you know, if you forget that, at least the 3 month average here is actually 120, which would be the lowest 3 month average reading. I actually don't know, but certainly back 5 years, I would suggest, or certainly 4 years at the very least. This is the worst 3 month average for at least 4 years. Okay. I want to show you next what happened to markets last month. You know, when that figure of 138, which was quite a bit less than what was expected, what happened? So let's have a look at the markets. I've got a few different market pictures to show you here, and this is a chart looking at the S&P 500, and the 130 data came here, and the S&P initially spiked lower, then it kind of got messy. We bounced, but in the end we dropped, and then dropped again, and we hit a low. The lowest point traded was actually at 255, so a full hour and 25 minutes after the data. From that point we then rallied and actually traded back up above where we were before the data was announced. So bear this in mind when you're trading, if you're going to trade equities off this release at 130. I think the equity space is just not straightforward. It's not easy to trade equities off payrolls. We sold off here initially because, hang on a minute, this is bad news. 138,000 fewer jobs created than expected, negative signal for the economy, blah blah blah. But as the day wore on, you know, the realization was, well, all right, 138,000, but you know what, doesn't really matter. The US is pretty much at full employment, and so perhaps these job creation numbers are low because of that, and that's not a bad thing. And actually the Fed aren't really interested in job creation anymore, or the unemployment rate, because they're so good. So actually it doesn't, you know, the thought process was that it actually wasn't going to have an impact on what the Fed are going to do. They're going to carry on hiking anyway. So actually it became a bit of a non-event for equities in many ways. The unemployment rate did drop to 4.3%, and that certainly helped with the reversal. The information flow last month was mixed. Bad on the headline payrolls, good on unemployment. That was the equity space. I think this is in many ways the hardest asset to trade. I think the dollar is going to be more interesting. This is how the euro dollar reacted to the 138 print plus, just reacting to 138. And here we had dollar weakness, and the euro dollar market was trading just before the data was trading at 112.67, and we topped out up at 113.44, so almost an 80 pip move to the upside, and then we consolidated sideways into the European close. Okay, so do bear in mind, you do get normally one short sharp move followed by that sharp movement calming down quite quickly, and then consolidation. What happened in T-notes? Well, this is what happened. T-notes spiked higher. In terms of the size of that move, well, we went from 126.10, let's say, and the top of the spike was 126.22.5, so not a bad size move. Pulled back 50% of it, found support, and then went and made new highs. Gold, this is how gold behaved. Sharp move to the upside. As you can see, the size of that, well, we came from 1265, and the top of that kind of first phase was 1278. So you got a $13-14 move there. Again, we consolidated, but then drifted higher for the rest of the day into the end of the European session. So that's what happened last time off a low ball payrolls print. What's going to happen this time? Well, let's have a look at a few charts. I've shown you this one, so that's the non-farm payrolls as we have seen over the last 12 months. What data have we had already this week on job creation in June? Well, we had the ADP employment report on yesterday, so this is the private sector job creation measurement only. This was worse than expected, and it dropped to 158,000. So you could say this is a bad lead. So as a lead indicator, this is bad news. But as I said this morning in the briefing, the ADP reading has not been a good indicator or a good predictor of the non-farm payrolls data. In fact, it's actually been really bad. So do bear that in mind. It hasn't been a good indicator. I think the best example of that was the March reading. March, the ADP number came in way better than expected, 255,000, an absolute stormer. 2 days later, non-farm payrolls was announced, and it got announced at 50, the worst reading in many years. So that kind of sums that up. Just this has not been a good measure, a good predictor. Last month, ADP, really strong number, 230,000. Non-farm payrolls, really weak, 138. So do bear that in mind. It's actually, if anything, it's been a reverse indicator in recent months. We've had data on the manufacturing numbers this week. So ISM manufacturing actually slightly reported this morning. The ISM manufacturing employment component did slightly weaken this month, although it does remain at reasonably strong levels when you're comparing it to, let's say, 2016. The services...
That was the market manufacturing.
Okay, yeah. The services sector, so the ISM non-manufacturing, that one also, the employment component here also weakened. Obviously, the headline you can see on the chart was very, very strong, staying up around some very elevated levels. But the employment component did drop back to 55, so it was a drop. But 55 in itself is still pretty solid. Okay, so I would say, if anything, the data we've had on employment growth so far, for June has been slightly on the worse than expected side. Okay. What about wage growth? This is the wage growth chart, and I would say so far in the last 7-8 months, this has just failed to really gather momentum. We've kind of just been stuck, averaging 0.2%. 0.2% is not enough. You know, we need 0.3s, 0.4s consistently, really to start thinking, wow, okay, demand for goods is really going to take a positive boost from genuine wage growth. And then that's, you know, the signal the Fed are really waiting for. Well, I guess the Fed are hiking. I guess if we get strong wage growth coming through, let's say in the second half of 2017, and at the moment it doesn't look like that's going to happen, but let's say you did get that, well then the Fed are going to have to accelerate their exit strategy. And then that will be something that really starts to shift markets, because markets aren't priced for like a steepening of the Fed interest rate trajectory curve. So this is an important number this afternoon. We're expecting 0.3, so do bear in mind that's the best we've seen since the summer of last year. Anything 0.4, 0.5, well, that would really probably make it the most important number of the whole lot. If this thing came in at 0.5, forget the non-farm payrolls reading. It would be the wage growth figure that dominates market reaction. 0.5, you'd get a hawkish reaction. You're going to get some dollar strength. You're going to get bond markets selling off. Gold will move south. What equities do with that? Tough to call. You'd say on the first hand, hang on, equities should go up. More demand for goods because of wage growth. But then what would hinder the upside would be the genuine risk that the Fed might accelerate their rate hiking cycle. So that would be a counter negative. So it'd be difficult to trade equities off that, I think. Of course, it could go the other way. Wage growth could turn south. You know, anything 0.1, obviously anything below 0 would be another standout reading. We'd really start to then question whether the Fed are going to hike again this year. If wage growth dropped below 0, that would really be interesting. That, from a trader's point of view, that selfishly, that's what we want to see. We want to see wildly out of line numbers. The likelihood is it's probably going to be 0.3 or 0.2, and you know, we'll continue with this being quite flat and something that isn't going to change anything, and that means markets won't react. Final chart. Well, no, it's not the final chart. This is the unemployment rate and how it's changed, and we're looking back this century. Okay, we're going back to the year 2000 here. And obviously the crisis saw this unemployment rate surge to 10%, and ever since then it's been a very consistent downtrend, and it's ongoing. And actually we've accelerated a little bit lower over the last 3 months, and this print is 4.3% in May, and we're expecting that to remain unchanged in June. 4.3% is the best we've seen since 2007. You know, it is a 10-year low here. Is this full employment? This is the kind of big question. Shouldn't we expect this unemployment rate now to flatten off? You know, can it carry on trending lower? Can it break the 2007 low? And back at the end of the 90s, in the year 2000, we were actually 4%. If I go to maximum now, you'll see, if I make that slightly bigger, you'll see that 1998, 99, 2000, we bottomed out at 4%. We kind of hit 3.9% in there. That's the lowest we've been in over 50 years. Okay. You know, something that the unemployment rate has not been an important reading for the last 12 months and more. You know, as soon as it dropped below 5%, it's like, well, fine. That's back to full employment. I think actually, if this downtrend continues, and let's say in the coming months this unemployment rate drops below 4%, I actually think this then might actually swing to become one of the most important measurements. If the unemployment rate breaks that 2000 low and makes a new 50-year low, that might then become a catalyst for the Fed to start accelerating their exit strategy. You know, if you're going to get the unemployment rate at 50-year lows, well then, of course, from a demand for goods point of view, that could lead to inflation expectations rising, and the Fed, you know, would perhaps be mindful of that and want to start increasing the rate at which they're hiking. Obviously, if you get unemployment rates below 4% plus wage growth at the same time, you know, meaningful wage growth, well then this is something that really could see the Fed, alter their course. But, that's not going to happen today. That's just something to be mindful of in the coming months. Is this unemployment? The closer it gets to 4%, the more important it will become from a hawkish point of view for the Fed. Here's what some of the big banks are thinking for today. So the headline expectation rate, according to Bloomberg, 179,000. Commerzbank, Deutsche Bank, Standard Chartered, they're the bulls. They think 210. Remember, if I flick back to the chart, 210 would be the best reading we would have seen since February. Others, more towards in line with expectations, Barclays, Bank of America, Goldman's, BNP Paribas, ING. And then slightly below forecast is Credit Agricole, HSBC at 175. I don't know, there's a school of thought here that, let me go back to that payrolls chart. We've had weak readings in the last 3 months. I think the days of plus 200,000, I'm going to make a comment now, and it might make me look very stupid in 45 minutes time, but I'm going to say it anyway. I think the days of above 200,000 are kind of gone for now. I just think that the unemployment rate, we're close enough to full employment for it to just become harder for new jobs to get created. So I just think, I don't think we're going to see north of 200 anymore. And that's not a bad thing. It's this full employment story. The Fed are going to hike. Look, the last 3 months has seen the lowest 3-month payrolls average for at least 4 years, and in that 3-month period the Fed have hiked interest rates twice. So look, the Fed they're not concerned about payrolls numbers dropping. I think you're going to need numbers consistently below 100. You're going to need wage growth down below 0 for the Fed to really sit up and say, hang on a minute, we've got notable economic weakness, actually we're going to have to stop hiking. So I think north of 200, I don't think that's feasible anymore. Obviously, I'm going to look stupid if it comes in at, let's say, 250 in 45 minutes time, but anyway, I'll risk that. My prediction is that we're going to get something quite weak in terms of relative to expected 179, remember. I think it'll be below 179. So what might be, and let me just final graphic before we go back to the actual charts and see where we might get the most interesting market reaction. This is a really interesting chart. This is the Danske Bank spiderweb chart, which is really tracking the health of the labour market generally. Look at around the kind of outer rim of this circle, and you've got lots of different labour market measurements. So payroll employment, that's at 12 o'clock. That's the non-farm payroll reading, okay? And then you can see lots of different types of measurements around the circle here. Job openings, hires, hiring plans, availability, quits, unemployment. Marginally attached. You might think, well, what the hell does that mean? And that's a question I asked Anthony 30 minutes ago. I can never remember what that meant. So that's persons not in the labour force. Remember, you're not in the labour force if you don't work and you're not actively seeking a job. You're not in the labour force. So those people, persons not in the labour force who want and are available for work and who have looked for a job at some point in the past, let's say in the past 12 months, but were not counted as unemployed because they had not searched for work in the 4 weeks preceding the survey. All right, that's what that means. Anyway, part-time for economic reasons. This is the weak part of the circle still. This is the only part of the labour market that hasn't fully recovered to pre-crisis levels. Part-time for economic reasons, that's people who have a part-time job but would like a full-time job, they just can't find one. This is the only bit of spare capacity left. The rest of it is you've got huge, powerful gains well beyond the kind of blue, is that blue or black circle? That's December 2007. That's pre-crisis levels. You've then got May 2016 in green and May 2017 in orange. So we've got huge outperformance in jobless claims, unable to fill job openings, temporary help wanted, payrolls, job openings, powerful gains here, hiring plans very strong, job availability strong, quits are now strong. Generally, this labour market is very solid. Okay, that's why the Fed aren't concerned about non-farm payrolls. They're not too concerned about the unemployment rate at this point. Really, it's wage growth, I think, that's the critical part of this report. Right, let's look at the let's look at the charts and see where we might get some movement. Right, let's talk about a figure that's worse than expected first. Don't forget, if all the data's in line, then there's no trade. You know, don't forget here, you don't have to trade this. I know there's a temptation to think that, you know, really important number, you know, hyped up by the press and us and big moment and I've got to pull the trigger. Well, actually you don't. You should only pull the trigger if the data warrants it. So first thing to say, if it's all roughly in line, then, you know, just sit back and maybe wait for the cash open. However, let's talk about two scenarios. Let's talk about worse than expected and better than expected. So, if the data's worse than expected, where am I going to be looking? I'd like to think that, well, worse than expected, obviously we're going to see some, let's talk about the dollar. If you want to trade the US dollar, worse than expected data, dollar weakness, I'd say cable's an interesting one to trade, and that's because what's happened so far this morning, we've had a big sell-off. Now that was because of sterling weakness, you know, bad data out of the UK at 9:30. But the point is, this has moved quite a lot lower already today. Dollar weakness would mean this thing moves back higher, and look, you got we've had an 80 pip sell-off this morning, so bad data, and you might expect an 80 pip rally. Okay, so because this market's sold off strongly, there's scope and room for this to move back higher off bad data. So dollar weakness against the pound might be something to have a look at. You could spin a very similar argument if you're looking at the yen, because you've had a similar pattern here with the yen weakening overnight, and so a bit of dollar strength against the yen last night, and so if you're going to get dollar weakness now, well then, you know, scope for this to move back to the pivot. All right, so if you want to trade the dollar, I'd say the pound and the yen are interesting ones to trade it against because there's room for that dollar to weaken. I say against the euro, less room for weakening, dollar weakening. You know, I'd say I'd trade euro dollar off strong data. This is the dollar strengthening. You know, the euro dollar hasn't sold off today like the yen and the pound has. So dollar strength, I reckon you're better off trading the euro, where you might see some of that big move higher from yesterday retraced. Okay, so good strong news, I'm short euro dollar. Really weak news, long cable or long yen dollar. Okay, with the euro dollar, I'd be careful on bad news. You know, the idea this thing can carry on going up. Well, as I said, we had a big move north yesterday, and anyway, we're at a 15-month high, so there's not too much room, I don't think, to have a dramatic move higher here. Okay, let's talk bonds. Let's talk T-notes. I think we've been, obviously bonds have had a bad couple of weeks price-wise. Look at this trend. Quite an amazing move. Okay, so naturally, where's the big opportunity? It would be bonds going higher off bad data. That's where you're going to see the most movement. Bonds going lower off good data, fine, yep, certainly possible, but the scope for, you know, large moves lower, probably less, because we've already had a dramatic move south. Okay, so I'd say your opportunity is long T-notes off bad news. Okay, that would be the best opportunity from a bond trade point of view. Let's look at equities then, where I think it's going to be tough to trade this. I know that the S&P dragged lower by the bond markets again yesterday, and you know, we've been sideways, nothing happening so far today. I mean, price points, you got yesterday's low to look at, 24.05. You know, we're a long way off that top that we had back on Wednesday. If you get a fib series on this, then that might be something by way of targets to look for on the way back up. But so here's the deal. if you get really bad news, as we said, I don't think if non-farm payrolls if it's bad, it's not going to change the Fed's mind. The Fed are going to carry on with their plan of action. So I think bad news it's just bad news. So I think bad news, you'll get the S&P break below yesterday's low, but people in the back of their minds are going to be thinking, well, is this bad enough for the Fed to stop hiking? That kind of thought process, which might prevent the sell-off being too aggressive, because obviously if the Fed stop hiking, you could argue in the short term that's good news for equities. So sure, I think bad news in the S&P comes down, but I don't think you're going to get a straightforward reaction in the equity market as you might do, in the dollar or bonds, for example. Good news, and yeah, there's room to move back higher. I think perhaps it's the wage growth data to be mindful of. If wage growth is really strong, then actually I think that might turn into a negative for equities in the end because of people thinking the Fed are going to hike faster. So I think equities is a harder one to trade, and that was certainly the case last month, and I'd expect it to be the case again this month. If you're thinking about stuff like gold, then remember what happened last month. Bad news, and gold had a decent move higher, and I'd say that's where your opportunity is for gold. It's buying gold off a bad number, and that's again just because of looking at how the gold price has behaved in recent days, weeks. I mean, we've been flat for the last couple of days, but we're on the back of a pretty powerful move lower here for gold. Just if you go back to the start of June, this has been a huge move lower, and we've got this key support, which is the May low. We didn't quite reach it. The low of the week was set on Wednesday, and we didn't quite reach 12.14, but obviously there's more room to move higher here than lower. But if we do get a really bad reading and you get a big move, do bear in mind 1,214, big price for gold. That was the May low. Okay. All right. I think that's enough on the payrolls preview, and we've got how long? 35 minutes until the figure is going to hit the wires, and I'll be back on the mic just beforehand. Okay. Thanks a lot.